Can the money you put into a stock be wiped out completely? And how long is it right to keep holding a falling share? In the silence of the night, when your portfolio on your mobile screen looks drowned in red, the most dangerous thing is not the market's fall, but the question rising in your mind, the one most people do not even say out loud. Will this money come back, or is it gone forever? In the beginning, we hear stories of profit, watch videos about multi-baggers, and it feels as if the stock market is simply a machine that makes patient people rich. But the real game begins when a share keeps falling, slips below your average price, then falls even more, and one day you ask yourself, am I an investor, or am I just sitting here holding on to hope? This is the point where the stock market steps out of glamour and enters reality. And the reality is this: yes, money in the stock market can be wiped out completely, and many times that wipeout begins in a very innocent way, with let's hold a little longer. The biggest illusion in the stock market is that people start confusing price with business. Looking at the falling line on the screen, we assume it is temporary, because markets do move up and down. And that is true too. Shares of good businesses often fall because of global tension, sector weakness, election anxiety, interest rates, crude prices, or a broad correction, and then recover over time. But not every fall turns into a recovery. Some falls are warnings. Some falls are breakdowns. And some falls are the beginning of a long story that ends with nothing left in the investor's hands except regret. That is why understanding the difference between the share has fallen and the company is breaking down is the most important thing. Now the direct question. Can the money invested in a stock go to zero? The practical answer is yes, it can. According to the US SEC's investor education material, if a company goes bankrupt and its assets are liquidated, common shareholders stand at the very end of the line. First come the creditors, bondholders, employees, suppliers, and other claimants. Only if something is left does anything reach common shareholders, and in most cases, nothing is left. The SEC's investor bulletin also says that the common stock of a bankrupt public company is likely to be worthless because the reorganization plan can even cancel existing shares. In simple words, equity in the share market gives you ownership, but in bankruptcy, equity sits in the last chair. By the time its turn comes, the hall is often already empty. That is why the thinking that the company is big, so it will not sink, can be very dangerous. Business history is full of countless stories where investors kept holding just by looking at the brand name, and slowly the value kept disappearing. Bankruptcy does not always arrive in a single day. Many times, the business deteriorates over years, debt rises, promoter credibility falls, questions are raised about auditors, cash flow weakens, pledging rises, receivables get stuck. Profit shows up on paper, but cash does not come in. From the outside, everything looks like it is running, but from the inside, the structure has already become hollow. Many times, the market price catches this truth before the management does. That is why seeing a falling share as simply cheap can become the most expensive mistake. Now the second big fear: delisting. A lot of people assume that the moment delisting happens, the money is gone. The truth is a little more nuanced. According to SEBI's FAQ, delisting means the permanent removal of listed securities from the stock exchange, after which they no longer trade on the exchange. In the case of voluntary delisting, promoters have to give an exit offer to public shareholders, and according to SEBI's FAQ, for acquiring delisted equity shares, there is a payment framework based on the value determined by an independent valuer, while shareholders may also have the option to retain their shares. But the practical problem is that once a stock is delisted, liquidity disappears. If the share is not trading in the public market at all, it becomes difficult for the ordinary investor to exit. So delisting does not always make your money zero, but it can make your investment illiquid, uncertain, and many times effectively dead. Especially in compulsory delisting or fraud hit cases, investors can get trapped. This is exactly where the danger of penny stocks becomes the biggest. People see the low price and think the loss will also be small. But the truth is the opposite. A 5 rupee stock can also go to zero, and a 500 rupee quality stock can also fall 30% and recover. In the market, a cheap price is not proof of lower risk. In many penny stocks, operator-driven moves, low liquidity, misleading narratives, and artificial volume are created. The price goes up, people buy out of greed, and then the exit route gets blocked. In such stocks, averaging down is often not investing. It is deepening the trap. Investors often forget that in the market, percentage loss is measured not by price, but by capital. If a 10 rupee stock goes to zero, your money is down 100%. It only looks like a small loss on the screen, but in reality, it is big. So now the most important question: how long should you hold a falling share? The answer is hidden less in time and more in reason. If the share is falling because the entire market is in correction, the sector is temporarily out of favor, or a strong company is being sold in short-term panic, then holding or staggered buying can be sensible. But if the fall is company-specific and the root of it lies in fundamental deterioration, then holding may not be patience. It may be denial. This is the biggest mistake investors make. They see the fall in the chart, but they do not see the fall in the business. They think the price will return to where it was, but they do not ask whether the business itself can return to its old strength. This is where sunk cost fallacy quietly enters the game. It is the mental trap in which an investor thinks, so much loss has already happened. What is the point of selling now? Let's just keep holding. It sounds practical, but many times this very thinking causes the biggest damage to a portfolio. Because the market does not care about your buy price. It does not move based on the fact that you bought at 500 rupees and the stock is now at 260 rupees. The market only prices the future. So the real question is not where you bought. The real question is this. If you had cash today, would you buy the same company again? If the answer is no, then holding on only because of attachment to your old buy price is not rational. Before holding, a sensible investor should ask themselves 4 or 5 uncomfortable questions. Is the company's debt under control, or is it rising continuously? Does operating cash flow match the profit, or is there only accounting profit on display? Is promoter holding stable, or are promoters quietly selling their stake? Are there governance concerns around management? Has the auditor resigned? Are there qualified remarks, or are related party transactions suspicious? Is the business model becoming structurally weak because of technology change, regulatory shock, or demand collapse? If the answers to many of these questions are negative, then treating the fall as just market mood may simply be deceiving yourself. Promoter behavior is also a very big signal. If the owners of the company themselves are continuously reducing stake, heavily pledging shares, or failing to give confidence-building communication, then an investor should be extra careful. A fall in promoter holding is not always bad, but its pattern and context reveal a lot. Smart investors do not look at the quarterly shareholding pattern for no reason. Because if the owner is quietly moving toward the door, then the outside investor should at least understand that something is wrong in the room. Trust is not built only on management commentary. It is built on skin in the game. Legal or regulatory trouble is also an immediate red flag. 𝐟𝐨𝐥𝐥𝐸 audit, forensic audit, exchange queries, statutory non-compliance, fraud allegations, serious whistleblower claims, auditor resignation. These are things that should not be ignored by calling them noise. The market can overreact in such cases, but many times it can underreact too. That is why blind hope is dangerous. If the issue is cosmetic, the clarification is strong, and the business is intact, that is a different matter. But if management credibility itself is broken, then a cheap valuation means nothing. Because in the stock market, the most expensive discount is the one you get on governance risk. Now let us talk about stop loss. Many people think it is only for traders, but in the language of discipline, stop loss is not just a chart tool. It is a principle of capital protection. In BSE's investor education material, a stop loss order is explained as an order in which a sell gets triggered once the price falls below a certain level. In the broader world of investing, this means that before every decision, the limit of loss should be defined. Whether you place an exact stop loss order or keep a mental stop, the idea is the same. The cost of being wrong should not be unlimited. Because the first rule of investing is not making profit, it is survival. Only if your capital survives can you take advantage of future opportunities. But here too, there is nuance. Selling every quality stock after a 15% fall is not always right, because market volatility in large caps and cyclicals is natural. That is why a blind percentage-based stop loss can, many times, push you out of a good business in long-term investing. That is why a better approach is to define 2 types of limits, a price limit and a thesis limit. Price limit means how much drawdown you can handle emotionally and financially. Thesis limit means what kind of event would break your original investment thesis. For example, if you bought a company for its strong balance sheet, clean management, and profit growth, and later you begin to see a debt spike, governance issues, and earnings collapse together, then the thesis is broken. Holding after that is loyalty, not investing. Many investors start treating averaging down like a magic formula. The share fell 20%, so they bought more. It fell 40%, so they bought more. It fell 60%, and then they said, now it will become a multi-bagger. This strategy works only when the company is fundamentally strong, is under temporary pressure, and you have deep conviction backed by data. Otherwise, averaging down is like putting more weight into a sinking boat. Averaging into a weak company does not reduce loss. It increases concentration risk. That is why there is a huge difference between averaging down and value investing. A value investor buys a business at a discount. A trapped investor buys more shares just to make the loss look smaller. From the outside, both look similar. From the inside, they are completely different. Sometimes, the best decision is to book the loss. This is not easy to hear and even harder to accept, because the moment you book a loss, the ego gets hurt. The investor feels they have accepted a mistake. But the truth is, in the market, accepting a mistake is not weakness. It is professional behavior. Money stuck in a bad stock also becomes an opportunity cost. It is not just giving you a loss, it is also preventing you from moving into a better business. If a share is 50% or 60% below its peak, and there are no clear signs of improvement in business fundamentals, then holding only because it has already fallen so much, how much more can it fall, can be dangerous. History is witness that a stock down 50% can fall another 50%. Mathematics says the same thing. After falling 50%, it needs a 100% rise just to return to the old price. And if the company is structurally damaged, that rise may never come. Diversification also plays a very big role here. 𝐟𝐨𝐵's investor education booklet clearly says, don't put all your eggs in one basket. And diversification is an important way to manage risk for long-term goals, even though it does not guarantee against loss. This means that if you put disproportionate money into one or two high-risk stocks, a single mistake can push your financial journey far behind. But if your portfolio is diversified, your position sizing is disciplined, and you focus on quality, then the impact of one stock disaster can remain limited. That is why smart investing is not just stock selection. It is also portfolio construction. Many times the decision to hold a falling share also depends on your age, goals, and cash flow. If you are young, have a regular income, have a separate emergency fund, and the loss does not disturb your life planning, then you can tolerate volatility in quality businesses. But if retirement capital, a child's education fund, or money meant for short-term needs is invested in high-risk shares, then the luxury of holding is not so easy. That is exactly why investing advice cannot be universal. The same stock can be an opportunity for one person and a danger for another. So before saying, I am holding, you should also ask, does my financial situation even allow me to hold? The most practical way is to divide a falling stock into three categories. The first category, good company, bad mood. Here, market sentiment is bad, but the business is intact. The second category, good company, temporary problem. Here, the pain is real, but there is a credible possibility of recovery. The third category, bad company, broken story. Here, the fall is not just in price, but in quality. In the first category, patience can be rewarded. In the second, selective averaging and time can work. In the third, exit is often the most sensible path. The difficulty is that investors often mistake the third category for the first, and that is what eats up their capital. So, can money in the stock market be wiped out completely? Yes, absolutely. In bankruptcy, equity stands last, and after delisting, liquidity can practically vanish. Should every falling share be sold? No. If the fall is market-wide and the company is strong, then holding and even gradual accumulation can be sensible. But if the fundamentals are breaking, management is questionable, promoter behavior is negative, the auditor is raising alarms, debt is rising, and the business thesis has cracked, then holding is not courage. It can become self-deception. That fine line is what real investing is all about. In the end, the most important thing. In the stock market, the one who becomes rich is not only the person who buys the right share. The one who becomes rich is also the person who sells the wrong share on time. Avoiding loss is not always possible, but avoiding permanent capital destruction is often possible. If the investor honestly looks at the facts, lets go of attachment to their buy price, and does not allow hope to sit above analysis. In the market, reality comes before recovery, and the investor who accepts reality early is the one who survives in the long run and grows too. So the next time you see a share falling, do not ask only, when will it go up? Also ask, is this business still alive? Many times, your real answer is hidden right there. If this video has taught you something new, or if you feel this information should reach more people, don't forget to like and share the video. Your small share can become valuable and useful information for someone else. If you have any questions related to this topic, or if you would like to share your opinion with us, be sure to write in the comment box. We read every question and suggestion from you, because your feedback inspires us to create better content. And if you want to keep receiving such interesting and reliable information about business, the economy, and the world in the future, then don't forget to subscribe to our channel GRT Business and also press the bell icon so that you get notifications of every new video directly. At GRT Business, we always strive to provide you with accurate, balanced, and reliable information. Our news and analysis are prepared based on information obtained from various news agencies, public sources, and public opinion. We make every effort to verify and validate each fact as much as possible, but in case of any possible error or dispute, the responsibility lies with the respective sources. Our only aim is to present you with a correct and trustworthy perspective so that you can understand any topic better.